Good morning, everyone. This is Scott Reese with Netherland, Sewell and Associates, a proud sponsor of the Intercom Conference for more than the last 20 years. Our next presenting company is Noble Royalties. Noble Royalties is a Dallas area-based private company focused on buying and managing oil and gas minerals and royalty interests. Noble was founded by their CEO, Scott Noble, in 1997 and has acquired over $2 billion in properties since that time. Here to share the story of Noble Royalties, as well as give a little bit of oversight into the mineral business in general, is Scott Noble. Scott, the microphone is now yours.
Thank you for inviting me to be part of this great conference, Intercom and the Oil and Gas Conference. And thank you, Scott Reese, for the grand introduction. Quick plug for Netherland, Sewell. We've been using them for almost 20 years now. They evaluate and do our year-end reserve for over 83,000 mineral interests, which is quite a feat in itself. And I can't thank you enough for your service to me and the company. And matter of fact, you helped us buy one of the great assets that we'll talk about later on. And we even named the meeting room after that asset. So it's been profitable to us. And your team was wonderful in doing sincere due diligence on that asset, giving us the foresight to be able to get comfortable with making that purchase. And we thank you for that. So real quick, what I thought I'd run you through for Noble Royalties is give you a little quick background on Noble Royalties, and we'll work you through kind of our history. We'll kind of talk about our challenges today, and then how we can overcome those challenges and kind of look forward looking for not only the industry, but for the mineral side of the industry as well. So we'll just kind of fly through here. Michael, if you're running the slides, we'll go to the next slide. So I thought I'd kick off and just give people a little bit of history of Noble Royalties. First of all, I drilled for 12 years prior to this. I was good, bad, broke, good, bad, broke, good, bad, broke. And I told Dad that I'm onto your cycle. I want to start looking at this industry and maybe a different risk-adjusted return rate. And that's when I started thinking about buying production rather than the bet. And that's when the mindset kind of shifted to buying minerals back in 1997. Since that time, we've had a remarkable track record of being able to buy over $2 billion worth of minerals and interest. We still have about $1.4 billion in assets under management. It's diversified across all lower 48. I think it's in 30 states, 460 counties. It's 83,000 unique wells. So it's evolved over time. We did a lot of that through private and a retail business at first. That evolved into partnerships successfully with KKR, then Blackstone, that was later rolled public as Falcon, and now we're with Apollo, and it's a fantastic relationship, and we're looking forward, and they've given us a little bit more room to be able to expand with our strategies and our scale, so it's kind of an exciting future for us. I think we've been very smart about diversifying our interest across all levels, whether it be geology, geography, operator, oil and gas. We've been extremely disciplined. I don't know if I've seen that in our industry in the last 2 or 3 years. That's concerning to me. We'll talk about that. And we're tech-heavy underwriting. So we're looking at performance, not inventory. We do give credit to inventory. We find out a way that inventory behaves and how we should underwrite it properly going forward. And we try to give credit where credit is due for not only the current production, but the future production as well. And I think we do a fantastic job of looking through the lens of the seller, trying to understand where they're coming from and trying to help them make a good decision, whether it be a landowner, whether it be an aggregator or collector, whether it be a mineral fund, or whether it be an E&P company. Next slide. So this is kind of the Holy Grail. That's actually our production going back to 1994 as we acquired these wells. And it's just pretty phenomenal that we would buy into something where we've had 100% reserve replacement almost each and every year, irregardless of any event that's out there. And my father always said that when you go to sleep at night, understand, son, that well is still flowing, that well is still pumping. And it doesn't know who's president, and it doesn't know of all these events that are out there. And it's just kind of nice to know that something else is working for you another 14 hours a day when you're not working your 10 hours. So it's often imitated, never duplicated. I think this is the type of curve that everybody's trying to produce. I think it's extremely difficult today, though, because when we made these acquisitions, 65% of those assets out there were conventional. They were on the tail end of their decline. They'll last another 35 to 60 years, but we were looking with a baseline underlying asset decline of probably 8 to 12%. Obviously, with the challenge of a new well that is fracked and stimulated, coming on with a 78% decline the first year, 40% plus the second year, 20-something% the third year. You're at about 9% of your income within 4 years, these landowners. It's a whole different dynamic that everybody has to take into consideration. And to be able to receive this type of reward would probably take you at least $5 billion to get the same risk adjusted return. And I don't see enough funds with that scale. I don't see anybody with that scale. So you have to be extremely smart in the way you're underwriting your current production and future production if you want to find a way to duplicate this asset performance. Next slide, please. So what do oil and gas minerals offer? Well, they offer a lot. So let's just get through these. You've seen this probably covered by a lot of people in the past, but I thought I'd throw it up there. It is a lower risk investment into expose yourself into commodities versus your traditional E&P, especially during this extremely low price environment. When you have that invoice coming in each and every day, your margins get very, very small. In the mineral and royalty business, the free cash flow is anywhere from 88 to 94% of that remitter revenue that comes in. And that's really what investors seek. All of that complaining about an E&P company is very natural for somebody that owns minerals and very easy to produce and kind of deliver that's out there. We're extremely disciplined from a debt standpoint. I think the public companies are disciplined as that. We have not taken on any debt ever in the history of our 20 plus years. I'm just not a big fan on that. I think the yield is from the field. I think the investors want to see that return, and probably the only time now to probably even entertain any type of hedging would be on gas, because sometimes gas has a hard time living into its future. So you might want to offset that arbitrage that's out there. They're obviously looking for an attractive income producing tax advantage yield. There are significant tax advantages to owning this. As a matter of fact, in a year like this, when you take your write down, almost all of your income is tax free. You'll be quite shocked of that. You've seen the impairments that you've seen from the big public E&P companies. That works in our favor for a particular year like this. And they may not see that maybe in the public entities. You certainly see it in the private entities. So you can take your choice of whether you want to have a basin pure play, which is risk and reward. You'll see that with Viper. You'll see a little bit that with Brigham Minerals that are out there, or you can be diversified across multiple basins and wells and operators, similar to what Kimball is. So there's different ways to play this on a private or on a grand scale. But when you choose a pure play, you are going to live by that reward, and you are going to die by that risk that's out there right now. And I think you'll be seeing some some pretty hefty double-digit declines across somebody who is just Permian based with their strategy today. So we diversify across geographically, geologically. We really are selective about our operators. If you look, and we have studied probably 10 different areas in West Texas, for an example, we call them 9 spots. And the difference between one section of land during peak was as high as, let's call it $30,000 per NRA. Right next door, $10,000 per NRA. And that will never, ever change because of the lack of capital, the lack of pace that operator can put to that. So they cannot realize the profits of that potential section of land. And I think when you underwrite, that's why we use such a tech heavy department for us to be able to decipher how is that profit going to be realized. We're not an inventory based company. We are a performance based company in the way that we buy. So we diversify across commodity of oil and gas. I think we are about 65 to 70% oil right now. That changes on a revenue basis as price of oil and gas fluctuates, but on a reserve basis, it's about a 65-35 split. We're diversified across conventional and unconventional. Obviously, there's a lot of pressure to buy under unconventional right now because that's where the rigs are, but that's also where the high decline is going to be when they disappear. We've recently gone from 1,700 rigs back in '94 all the way down to 1,000 rigs just recently to 600 rigs after the OPEC decision. Now we're about 250 rigs that are out there today. So that's certainly a concern if you were counting on a lot of development, and there's going to be a lot of time in between that rig jumping on and off your section of land going forward. And then kind of the new thing, which is political risk, which used to be global and overseas, is now home. Matter of fact, it's probably more political risk at home than it is overseas right now. That needs to be taken into consideration. Those are some reasons why we have avoided Colorado. Marcellus is in its own little jeopardy now with the way New York is pushing your inability to be able to kind of move that gas around. Isn't there yet. It looks like it's headed in that direction. So finally, what's attractive? It's what's free that's attractive. You know, I talked to Bob Simpson, one of the first big founders of oil and gas, which started Cross Timbers Royalties, which is publicly traded. And he's got, you have to understand what's free that's very attractive. All that future development without any additional cost. If you had a one-story building and you didn't have to pay for the second story up through the 10th story over the next 10 years, it would be a highly attractive investment if you were in the real estate business, to give it some sort of analogy out there. So it's what comes free that is highly attractive to us, to our investors. They are paying for the growth, they are paying for the reserve replacement, they are paying for the fracs, they are paying for the refracs, and we share the reserves, but not the cost of all of that going forward. So I think it's neat that our industry can match supply and demand in a fairly short amount of time. And we just went through a heck of a hiccup here with COVID. I mean, it's big, it's unprecedented for all of us, right? But to be able to balance our supply and demand and take that fear away within about 4 or 5 months is pretty encouraging. And that within the next 2 years, probably rebalance based on whatever our GDP will be, whatever our new global habits will be. Oil and gas between OPEC, non-OPEC, and now locally, domestically, appears that they're starting to pay attention in how to balance supply and demand and all coming together. And I haven't seen that before. We need that going forward to be able to have a nice price environment, to increase our rig rate, and to get our assets realized and move them from inventory into revenue. So finally, there's kind of some upside with consolidation. Obviously, if a lot of these mineral funds will come together and consolidate or buy each other out, you're going to get greater stability closer to that curve that I showed you earlier. That's obviously an exit that people are looking at. I think right now the public entities probably have a tough time making any acquisition in the next 18 months for a lot of reasons, and I'll just leave that alone. Let's move to the next slide. So why is this a little bit different environment? Let's discuss that, because there certainly are some big challenges that are out here. So the market volatility is big, and these gaps seem to be shorter. So I'm a little bit concerned when I see peers or competition underwriting a perfect scenario for the next 10 years. And these interruptions seem to be closer to every 3 and 4 years rather than every 7 to 10 years. And that needs to be taken into consideration. And I think the people buying these minerals need to be extremely loyal to the investor. I don't see that enough. And we will make the same mistake that E&P has, and you'll see an exit of capital if we don't start paying attention to underwriting really the behavior of our asset and the behavior of global and supply demand that's out there. So when we take a country from 5 million barrels a day to 13 million barrels a day in a short amount of time, I don't know how anybody thought that the price of oil was going to hang in there high at any point in time. So we have inventory that is endless at this point in time. We have not created a supply and demand problem locally, which has kind of slowed down M&A. But I think that will pick back up when E&P starts to drill what's profitable rather than what attributes to growth that's out there. So they need to get out of the science business and they need to get into the profit business pretty quick, because we're going to get tired of hearing about the rock. We're going to get tired of hearing how great they are with their science. Investors are demanding results, and the patience of the politicians is short right now. So asset predictability is a little bit more difficult for any engineer, including Netherland Sewell, when you have these rapidly declining wells, even when you're paying for PDP. So a PDP, PV10, PV12 is actually very difficult to be able to be fairly accurate with that. And I think a seller needs to be open to when they hear a PV12, because that number can move up to 20% depending on the engineer that's running those curves. So that predictability has decreased when we move from conventional to unconventional. So minerals are still viewed as a de-risked investment. They have been for a long time, but now you're seeing them traded closer to E&Ps, probably closer to for the reason why these are really swift declining assets and they move almost pound for pound. And if you don't diversify across different basins and you don't diversify across different operators that have different capital balances that are both healthy and maybe some unhealthy that are out there to try to get some big arbitrage, then I think you're just making a mistake on building your portfolio. In the past, we've had OPEC plus the war on energy. That's only increased, not decreased. We don't see that going away, especially if we lose the election, which is near term here as well. Then we'll see more pressure on these assets. It could increase the price of oil, but decrease production. Maybe a nice trade-off, may favor us. Who knows? We'll just have to wait that out. So next slide, we'll kind of move past that. So mistakes of the industry. I think the big mistake starts with E&Ps. I think when they were buying four-way closures and they're buying all these nice little small fields for just to kind of illustrate and dramatize it a little bit, then there was a nice supply and demand issue. When you hit a big field, there was a market for it and there was great M&A and everybody wanted to chase the rare painting that was out there. But when we got into these shale plays, which is by the county, not by the play or by the field, then you could get way over your skis and you could get land heavy, not have enough money to be able to develop it, to be able to give the investors an attractive yield. And I think that's what they've done. So the land grab was big, huge, leveraged, costly, and their ability to develop wells at a high enough IRR to be able to handle all of that overhead has struggled. And as we developed and discovered more zones and more inventory, the price of oil came down as our production came up, and we drilled ourselves out of another boom to some extent. But there's probably, when you look even at the wells today, there's probably, you can look at the impairments. That's averaging about 20 to 27% for these public companies. Writing down at this price, it makes 0 sense for them to be able to develop that. We need to think hard about that from the mineral standpoint of underwriting that inventory. Probably 30 to 40% of the inventory that we were thinking about as an industry, mineral industry, last December, just recently, is probably not attractive today, and probably not attractive till $55 or $60 oil, maybe even $65 if you are loyal to the investor. If you're not loyal to the investor, they'll drill like we did recently. But I think we E&Ps have to move from growth at any rate to growth at an efficient rate, and even satisfy themselves by just having reserve replacements. There's nothing wrong with, you start at 100 barrels a day on January 1st and December 31st, you're at 100 barrels a day. You will get pricing appreciation and you'll be perceived as a winner. So be patient with your growth, do it at the right pace, and our mineral buyers will adjust to that. So that underperforming financial returns has been an exit of money out of E&P. Whenever that happens, it has a elastic effect that eventually gets down to the mineral, where now we have investors pretty skeptical about maybe the mineral business, and we can only earn their trust through underwriting correctly, fairly, performance-based, and returning attractive yields back to our clients. We have to be more loyal as an industry back to those clients, rather than bragging about, I have more NRAs than you. So I think it has shifted most recently from an inventory-based model to performance-based model. I think those inventory-based models are struggling. They're trying to buy straight PDP right now to try to window dress their portfolios. I think they're going to continue to have difficulty buying that to kind of window dress their inventories. They may want to come to us to see if we can help them kind of reset, rethink, repurpose their portfolios. And some of those assets that they bought at those high prices, unfortunately, those CEOs in that group will probably never be in the money from their incentive standpoint. And it may be a good time to just kind of reset, rethink, start a new fund, and you'll be in the money. You're probably better off ending a fund and starting a new fund than trying to window dress that back into great success, because it's kind of like having 100 hours of a 2.0 GPA and trying to make it up in the last semester. It's not going to work out very well. So let's see here, investors were forgotten. So we'll kind of move on. You can see in our nice little picture there of Dumb and Dumber, that's kind of our last cycle. I don't want to say we were dumb or dumber, but they were certainly aggressive. They were certainly counting every piece of inventory to win the bid that's out there. And there's mistakes made. There's just no other way to put it. Next slide, please. So how do you help reset your approach to minerals? The strong and discipline will survive. If those funds that are having difficulties during this last downturn due to pricing and inventory right now, if you want to put it that way, if you don't have more money supporting you, then you're just going to become a zombie fund, a zombie mineral fund, and you're just going to be in a blowdown phase, and you're going to have to wait out that decline curve, and you're going to have to wait for that price depreciation, and your exit's probably going to be 2 years from now, and that's probably going to be where a lot of funds are at this time, the way they're being rolled up. There certainly is an E&P strategy shift at this time. Their prioritization, their most profitable wells, are prioritizing their wells to be closest to already facilities that have been built so they can reduce their costs. I think what a lot of underwriters have not done from a mineral standpoint, if they really haven't looked at the single well economics. We look at every single well and every single bench. We run the IRR, and if that IRR isn't at a single well economic of an IRR of 30 or more, then it's probably not going to be drilled, because by the time the E&P drills that, has their G&A, tries to return an 8 to 12% yield back to their shareholder, it can't be done when you kind of get under sub IRR 30. Therefore, it's going to be hard for a CFO in the future for E&Ps to approve a low IRR well. There has to be something special about that. So obviously that's why the rig count's going to come down, but the performance is going to go up. So I think that's probably a good shift for E&Ps. And we probably ought to be kind of looking at our years by lateral feet in the ground, rather than rigs, because the efficiency's gone up and the lateral feet has gone up. So 400 rigs at 7,200 feet may be better than, 700 rigs at 5,200 feet as an example. So we'll start paying attention to that as well. So underwrite the most likely outcome is what we do. We historically look at the behavior of the asset. We look at the behavior of the operator. We look at the economics of and performance. It's not all about the rock, what people say. I know that's exciting. I care about the performance of the operator on the rock and the velocity that they move on and move off location and back on location, and where we rank as to their total inventory as well, because I own a lot of rock over there in Compass, and I've been bragging for 20 years that oil and gas is still in the ground, but they're not bringing it out. And that's just not a good position to be in when you're talking to your investors out there, and you need to keep that in mind. So next slide, please. So moving forward is, I think everybody kind of needs to sit back and rethink and think about how they're going to underwrite to the most likely case, rather than this utopian all inventory future that's out there. And as a matter of fact, if you did the math on them underwriting 18 to 24 locations, and you did that across all the sections of land, there wasn't enough CapEx in the world to be able to underwrite what a lot of mineral funds have underwritten in the past. I think that's just a big mistake. And I'm not saying that for all, I'm saying that for a lot, because we're in those bidding wars all the time. And it's just, it was just a landman based operation. And I think they ought to consider getting a tech team in there with petroleum engineers and petroleum techs, and start kind of rethinking the way they underwrite their assets from now going forward, and they may be able to fix their portfolios out there. So time to rethink. I would create new strategies, and I would look outside the box. If you're a pure play, then find and maybe diversify across more operators to be able to get that hit rate of the rigs kind of coming your way. You may rethink by diversifying some of your portfolio now and redeploying it in an area you have more confidence in, and kind of speed up that velocity of money that's out there as well. And then redeploy. So either you're into funds, start a new fund, or you really start rethinking where you're going to, a lot of people are kind of moving to some of the natural gas assets around the country. And that may be something that where people are trying to act fast. Some people are kind of looking at PDP only and getting a little more PDP heavy. Next slide. So my partner with Noble Royalties, well, we want to be on your preferred buyers list. I mean, we were there for 2 decades. We want us to be your first call. We want you to give us a shot at coming up with some type of creative solution. We're smart. We've been doing this a long time. We have Apollo on our side. We understand these cycles. And typically when you're in a volatile cycle where the pace and rig count moves swiftly, And where the commodity price moves swiftly, you have to be doing business with a tech team that where we can agree to the cash flow today, we can agree to the drilling wedge going forward, meaning the pace of the rigs kind of going forward, and we can give you a reasonable, most likely case of what's going to happen. We're not going to underbid you. We're not going to overbid you. I think it's extremely fair to give any family, any owner, any asset owner, or mineral fund, or E&P, the true value of their asset, to where if they passed away tomorrow, that's what they could liquidate that asset for if they went to market. I don't think it's fair to be hyping and aggressive on that. So we really try to get solid to where if you were just doing this for your estate purposes, it's an accurate accounting of what we think is going to happen. And it could happen a little bit faster than that, a little bit slower than that, but we're really going to try to look through the lens of you as an owner, try to understand the asset better than actually the exploration and the owners itself, and then present our case. We're very transparent. We enjoy that, and we sit down with everybody and we work through all of our math with everybody. So I think that's how we close the gap, is when you take something from emotion to non-emotional, when you look at the actual numbers that are out there, they kind of start speaking loudly for themselves, and it becomes an aha moment of, yeah, that's what that asset should be doing in the future. So we love being capitalized by Apollo. They are just a fantastic group to work with. Can't thank that team enough. We meet bi-weekly, and they are very, very constructive meetings and very creative meetings. And we're always forward thinking, how can we improve our underwriting? How can we improve and increase our volume? How can we work to help E&Ps? How can we work to help aggregators and landowners? And it's just a different position for a landowner. And I'll just comment on a landowner. I mean, Daddy said, never sell your minerals. And that was decades ago, by the way, 6 decades ago. And that was based on finding a asset with 18% natural porosity, that flows for 50 to 100 years, that will go to a water flood, that will go to CO2 flood, that really has zero decline when you look at the reserve placement out there. That was based on somebody making them an offer of maybe 100 to 300 bucks per net royalty acre. But it's completely different now. Now you have fracking that is at risk with a change of any leadership in the White House. You have high decline wells, and you have offers that are coming in at 5 to 15,000 per NRA. So the dynamics and the offers coming toward a landowner are correctly matched, where it should be a very difficult decision for a landowner to hang on and take on that risk, depending on the risk tolerance, or to exit. And I just think it's a terrific place for landowners and mineral buyers to be able to strike a deal and balance that risk and reward kind of now and going forward. So last thing would be talking about our E&Ps that are out there. And this has kind of been a great strategy. One, we align with E&Ps on a line of sight. And the second, which is bigger, larger deals, which you may have seen the recent Antero deal, which would be overriding royalty carve-outs. And this has been highly successful because it has not affected their line of credits that are out there and their debt piece. And we've been able to go in there and work on some large carve-outs that are out there. So if you're an E&P that you're seeking money that don't want to affect your RBL, then maybe we're a person to look toward that. We know Apollo is sharp. We have Shannon Manor working with us now. We have Chase Morris working with now on the business development. So we have an actual organic team on the ground and a business development team. And I think that's unique setup for us. Next slide. I think that's where we are. So I kind of gave you an earful there, but it's a lot to cover. We've been in it a long time and there's been a lot of changes, and I just thought I'd get that out there and we can move to some Q&A.
Excellent presentation, Scott. I really enjoyed it and took several notes from there, and want to address a couple things that I think you can expand on. One is pricing. Where do you see the market right now? And is this a lower for longer, or given all the supply potential in the world, are we in an environment for oil and gas where we're in lower forever, or at least for the foreseeable future, in terms of the ability to increase supply so quickly?
A couple things on that. I think one, when you're underwriting that and you're backed by a private equity backer, they're really going to try to hold you as close to the strip as you can. I think we debate that biweekly with Apollo, with other peers in the industry. And right now you're seeing the strip from an oil standpoint in this 42 to 46 range. I have pretty good confidence that we'll break through that, but I think it's 3, 4, or 5 years from now, and we'll be in that $50 to $55 per barrel range, but you're not seeing it in the strip. And it's just a guesstimation based on experience. And the reason why I'm a little bit more bullish than the strip is on an oil price is I'm looking at the lack of rigs working right now. I'm looking at the lack of capital. I'm looking at the difficulty that even large private equities have in attracting investors to this space. And I think it's just going to be very difficult to attract capital back to the space based on, one, the historical performance, which has been poor from an E&P standpoint. And I think we have to earn their trust for quite some time. And that's going to mean lower rig count. That's going to force a pretty hefty decline on a domestic basis, probably from at least by 2 million barrels a day, maybe a little bit more than that. And then we're going to get pretty smart. E&P is going to get really smart about reserve replacement. They're going to drill in the right areas rather than all the areas. They're kind of going to eat through those main fairways a little bit, and they're going to, and while we're earning trust of the investor back, the price of oil is going to creep up above that strip and get to that 55, 50, 60. If you remember, that was about the price when OPEC and kind of Russia started having the debate over supply and demand at that time, and they wanted a bigger piece of the pie. But by then, America would have had a big enough hiccup. We'd have lost 2 to 3 million barrels a day, which helps satisfy OPEC and Russia for, we were basically eaten into every growth of the GDP on a global basis. They were receiving none of that and capturing none of that. And come last March, they had had enough of us capturing the market. So I think that's a big adjustment there. On a natural gas standpoint, it's living in that 210, 215 range, typically lives in that 250. We're seeing the strip go as high as 290. People have a really difficult time believing 290. It's just too easy to hit a big gas well today and balance that supply and demand that's out there as well. I think we're going to have problem moving around natural gas or any oil and gas. You know, this becomes it's, I used to work with politicians a decade ago, and I said, they preach regulation. They mean, I want to run you out of business, and they'll settle for restricting you out of business, but they're going to preach safe. But their goal is the war on energy for it to go away. Their goal is the electrification of America. We'll talk about that in a minute, where I think we're headed in that direction, where we like it or not. I've been in enough rooms with the super majors to where that's a theme, the electrification of America. They're electrifying their rigs, they're electrifying their cars, they're lowering their emissions, they're lowering their methane gas. They're doing that, responsible ESG business that is, I think it's going to be a talk coming up pretty soon from this conference, which is good. But that certainly is a shift. And on top of that, people can raise money to go toward that asset. So I think these private equities are going to follow the money, and they're going to find a way to make money at it.
Well, we will get, hopefully have enough time to get back to that. I want to talk to you, one of the things that I find, very inspiring, to be honest with you, I've always tried to live a life of win-win, and you mentioned, striking fair deals. I applaud that. In this environment, how do you walk out of a room after negotiating, given the uncertainty of the environment, for the other party to walk away feeling like they got a fair deal?
One of my sayings is, I'd like to have dinner for you, and I'd like to have a dinner with you in 10 years and figure out who got the best of who. I think that's a great goal,
Sure.
because there's so many things that move back and forth, and the commodity pricing and the rig pace will dictate more than anything of the way that we underwrote that. So we're fully transparent in the way that we sit down and underwrite. Our first process is sit down and agree to where your cash flow is today, to make them recognize what their cash flow is today, because they really don't want to recognize where their cash flow is today. And then we start working forward as to the historical pace on their asset. and then where the CapEx is of that operator. And then we're able to look back and see if the rig count's at 250, that means there's 32 in their field. That means there's one with your operator. And we're able to kind of, do you see where we're headed here? Are we underwriting this wrong? And we get the seller to agree with our rig pace, with the pace of development. Then we start working on the economic versus sub-economic inventory. And by the time we break down the PDP and the agree to the cash flow, by the time we start agreeing to the future pace, by the time we start agreeing to the economic and sub-economic inventory that's out there, we've got a pretty good picture of how that asset should perform. So we may call it a fair deal, but we did win $2 billion in offers. So you're on the top end of fair, if you want to put it that way.
Sure, it's a good deal. We only have a few more minutes, so I want to ask you a little bit about, you mentioned Apollo, and you guys are active. How do you what is your capital strategy? Let's say over the next 6 months, year and a half. What do you see your capital strategy being?
Well, I think we're fortunate that we have a tech-heavy group to where we can help close the gap. So obviously there's been a buyer-seller gap, but when you have a technology advance like us where we can get behind the strip and we can run the evaluation rather than just a land-based throwing out a price per NRA that I can sell it for more than I paid for it, and you're looking for the next PT Barnum victim out there that's going to buy you out of your situation and stand in your shoes at a higher price. We're very disciplined. We work with all groups. We work from landowners all the way up to E&Ps. We're really to help facilitate their goals as well. So our strategies are fourfold, actually. So we've got an organic boots on the ground. We've got a line of sight. And we're calling on those people and working with brokers around the country. And at the same time, we're working the other end with the big mineral funds and with the E&Ps as well to try to help provide capital solutions for them while they're struggling for capital. And some of those E&P solutions could be very small. It could be prepaying for 4 ducts. It can be working with a small override, but a high concentration that after we get our certain IRR, then it reverts back to them at a smaller interest to be fair with them. But we're here to help with E&Ps. They probably just need 4 years to get the ox out of the ditch, right? They don't need 20 years, so that's where we're trying to work with them. So the strategy is it's broad, but basin wise, we're really not dealing with the politically unpleasant states.
Gotcha. Well, listen, that's all the time we have. Great presentation. And I certainly know, like you said, you want to be people's first call. So I'd encourage people to do that. I think the most regrettable thing is that unfortunately we're not able to meet in person, because I sure would love to buy you a beer at a cocktail reception and ask a bunch of the other questions that you raise. Certainly sounds like a great conversation. Thank you very much, Scott. And I encourage everybody to reach out to you if they have questions.
All right. I appreciate the time and good luck with the rest of the conference.
Thanks.